Hello and welcome to Rebank. I'm your host, Will Beeson. Rob Hadick is a general partner at Dragonfly, a $2.5 billion crypto venture fund. Dragonfly's portfolio is a who's who of leading crypto projects, including Anchorage, Ava Labs, Blur, DYDX, Lido, MakerDAO, Ava Labs, Near, Polygon, and many, many more. In this conversation, Rob and I discussed the recent change in tone in Washington regarding crypto, the implications for the industry as crypto goes mainstream, the next 2 to 3 years of stablecoin market development, investing in CeFi versus DeFi, investment dynamics as a top 5 crypto fund by AUM, and more. Thank you very much for joining us today. Please welcome Rob Hadick. Rob Hadick, welcome to Rebank.
Thanks for having me, Will.
It's great to connect with you, reconnect. I think we met at a dinner in London earlier this year, which was great. It was around the Digital Asset Summit, DAS, in London, which I thought was a great event, really focused on institutional use cases in crypto blockchain.
Yeah, it was an awesome event. And that was right around the time that people were getting really excited. Again, I think volumes were just taking off into March. And you can just kind of see the excitement in the space continue to pick up. ETFs were starting to really take off at that time. And it's kind of just continued into March and through April. And frankly, it's made me really excited to have this conversation with you again.
Great. Likewise. I mean, there's been some turbulence also. Prices were really strong at the very beginning of the year. Things cooled off a little bit. Meme coins have gone crazy. And now here we are. I don't know about you, but I've been refreshing Google News today, waiting to see if there's an Ethereum ETF update. Today's the day that the VanEck ETF should be approved or denied. Yesterday, there was a House vote on FIT21. This is a fascinating week.
Yeah, it's been a really exciting week. Last week, I think a lot of people were really down in the dumps, especially around the Ethereum ecosystem. Price action, to your point, had been pretty bad, especially relative to like Solana and BTC for a while. And I think people were just concerned that the US regulatory regime was going to continue to put its foot on the neck of crypto. And that changed basically on a dime late last week and then into this week. To your point, you mentioned FIT21, but I think this even starts with SAB 121, which was the Congressional Review Act, which essentially is like a rebuke of the SEC and one of their rulemaking procedures by Congress. And so what happened with that was that late last week through Congress, they repealed SAB 121, which was basically a rule where the SEC gave guidance to banks that they had to account for digital assets if they custody them just as a liability, making that essentially impossible for banks to custody crypto and to get involved in the ecosystem. And that was clear bad policy. And it would make us safer, make crypto safer, it would make the user safer if banks could get involved in the ecosystem. And it was clear the SEC was just doing it to try to keep banks out. And so Congress, for the first time in a bipartisan manner, that rebuke of the SEC with the repeal of SAB 121, that passed the Senate, 60 votes. Those 12 Democrats, including the majority leader, Chuck Schumer, right? And so that was the start of what seemed to be this kind of like turn on its head of the US regulatory climate. And what's interesting about that is before that vote happened, Biden had essentially, or the White House had come out and said, we're going to veto this if you pass the CRA. And that veto still hasn't happened. And very soon after that CRA passed, what you heard was that the SEC was changing its tune on the ETH ETFs, as you mentioned. We went through, it was essentially a month of radio silence, several months of very little back and forth with the SEC and the issuers. And everyone assumed that the ETFs, in fact, I was on CNBC's Crypto World last week, and I said explicitly, I was like, I see very little chance that this happens next week. That domino of SAB 121 really changed the tune of the White House. And so what we've heard is that the ETH ETF is, at least the VanEck, today, their 19B4 is likely to be approved. We still have to go through an S1 comment process before there can be trading, but it's really got the excitement of the space back. And then we had FIT21. And actually, right before we jumped on this call as well, we also had essentially a CBDC bill that also made it through the House that doesn't allow the Fed to issue a CBDC. So we went from a week ago having no crypto-specific legislation ever make it to the floor of the House or ever pass Congress to having multiples in 1 week. And so it's just a really, really exciting time. And I think what it highlights is how we as a body of people who are pro crypto have been able to show that this matters and have our voices heard in Washington. And now the administration seems to be, at least in some way, listening to us. Now, the Fit 21 is not a perfect legislation by any means, but it's a start.
Yeah. Well, look, I mean, as an American, this feels like it's a long time coming. Personally, I've been really frustrated, certainly with the lack of regulatory clarity that's been offered at any point in the US around digital assets. And I'll use the term digital assets because crypto can be such a polarizing term. I'm not, and I'm sure you're not, in any way fans of fraud, theft, crime, graft, a lot of what is unfortunately mainstream characterization of crypto. But because there have been examples of bad actors in the space over time, it's been so easy for rulemaking bodies and the powers that are to basically promote a sort of crypto ban, right? This like anti-crypto army, Elizabeth Warren type concept, which is just a broad brush quash on innovation that is happening very actively in the US. I mean, you're seeing it on a daily basis from your seat. It's going elsewhere in the world. And again, using the term digital assets, I mean, what we're talking about when I talk about digital assets, it's re-platforming financial markets on blockchain, financial markets and a lot more. But if we're not able to do that in the US, we're at a significant disadvantage. And there's zero justification for any sort of rule or policy that prevents responsible innovation in the space.
100%. We see it, to your point, all the time. There are a lot of incredibly smart people that are coming to our US universities. They are doing deep research here. They're doing, oftentimes in their PhD programs, funded research here. They're meeting co-founders here. They are thinking about solving large global scale problems here. And then they're looking around and they're saying, this place does not want me. It does not want my tax dollars. It doesn't want the innovation that I want to bring forth. And they're leaving. Right. And these are people who are passionate about, to your point, re-platforming or open finance. They're passionate about bringing finance to the underserved. They're passionate about democratizing and incentivizing the way of which we interact with software and open sourcing that software. And they just don't feel safe. And it's actually really sad because, I have a couple of good friends who, husband and wife team, they are, entrepreneurs. They founded a business together where they spend all of their time thinking about how do we make DeFi more accessible and easier to use for institutions and consumers alike. They are dual citizens. They are highly, highly successful. They've been educated at the biggest universities, the best universities in the country. And now they're thinking about having their first child. And they're looking around and saying, we should leave. And they're large taxpayers. And they've been awesome in their time here. And that's something that we see every day, every week. And it's just sad, right? And it has nothing to do with what you said, which is crime or theft. It has to do with, we can say that we want to prevent theft or we want to prevent crime, but instead we're going to kill the whole space when that is such a small part of what is happening here. And so it's really unclear to us, sitting from this seat and when we talk to, lobbyists and regulators, et cetera, why Elizabeth Warren has taken such a strong stance and why she's been given the reins to do that with Gary Gensler and the SEC. But we're really glad it's changing, and we're hopeful that there's a new regime coming forth.
Picking up from there and starting to focus in on your work as an investor, what do you think a sustained change in tone on crypto in Washington would mean for you as an investor, for Dragonfly as a firm?
Listen, I would say this. We are probably inarguably the most global fund that is crypto focused or entirely crypto focused. So we have this tagline, global from day one. We have half the team in Asia. And our approach has always been that you have to understand what is going on in Asia, what is going on in Europe, what is going on in the US to appropriately invest in this space. Because crypto is essentially borderless money and a borderless monetary system. And so you have to understand how consumers and institutions want to interact and how they want to interact together to be able to invest with thoughtfulness in this space. And we're going to continue to do that. That said, when we have our discussions around, this couple that I talked about earlier, their business or other types of entrepreneurs, we regularly look at what might be a best-in-class team that's innovating and say, this is not investable if they stay in the US. And we might have that conversation with the entrepreneur and say, have you thought about where you want to do this business, where you want to corporate, where you want to live? And oftentimes we see them say, listen, I understand and I might be willing to move. And sometimes they're not. But that actually is a thing that we have to think about, which shouldn't be the case, right? And so we do deep legal and compliance DD on everything we invest in. But in the US specifically, it's become such a big part of how we have to think about the world. So getting clear guidelines would allow us to take a step back and really understand this is what will work here. And this is what will work with this SEC and regulatory climate. And then we'll be able to very quickly form a thesis around what works here and what doesn't, versus always trying to play in a gray area or always having to have those conversations around, can this type of innovation happen here? So I think it would open up the floodgates for innovation. And I think it would probably increase our focus in this country.
I think you're totally right. So much of the innovation right now is either focused on markets that are smaller than the US or use cases that are adjacent to the stuff that would move the needle the most. And so the ability to really focus on the biggest problems in the biggest markets with clarity would potentially accelerate much needed innovation in finance and other parts of the economy, right?
Absolutely. So the U.S. is obviously the global economy, right? Or it's the driver of the global economy. Along with China, it's by far the biggest driver of global GDP. And so our belief is that for any innovation to really take hold globally, it also has to happen here. And I think that's probably not controversial. And so that should absolutely be able to take place if we have better regulatory climate. And I think what'll be good as well, and almost undoubtedly so, is that the big US corporates who have spent a lot of time thinking about the space, but haven't really driven full force into it, they'll see that as a green light. And so all of a sudden you have these big tech companies, these big payments companies, the big banks say, okay, now we are really going to put our money and our time into this.
So looking at a specific use case, stablecoins is an area that has really gotten a lot of traction in not just crypto, but more importantly, real economy use cases, everything from cross-border payments to people in hyperinflationary or economically unstable countries having a safe place to save. I know you have spent a lot of time looking at the stablecoin market. You've made an investment, pretty recently led an investment in a company called Agora that's building a new approach to stablecoins. What do you make of the opportunity in the stablecoin space? What excites you most there? And then maybe we can drill down on some of the nuances.
Stablecoins, biggest product market fit in crypto. The opportunity set in global payments is, undeniable. Stablecoins today is only 160 billion or so outstanding. It's quite a big number, when you think about it, but relative to even like the euro dollar market, which is 15 trillion, or broader global payments, it's still quite small. But, one of the things that we've seen in that space is there is just insatiable US dollar demand in emerging economies. And they have economies and currencies that are inflating, that are essentially eroding away their buying power and their access to goods. We complain about inflation here in the US, and at times inflation has been bad. And then you go and you talk to somebody in these emerging economies, and they're saying, oh, you have 3-4% inflation in the US. I would die for that. That would be a life changer for me. And so they want US dollars and they want to buy goods in US dollars and they want to save in US dollars. And stablecoins have provided access to US dollars in these different parts of the world that previously was unable to happen in any real way. We started to see P2P payments. We started to see cross-border payments, as you said, B2C in places like Turkey and Southeast Asia. If you go to a hawker market in Singapore now, if you've ever been, which is kind of these food markets, a lot of people will take payment through Grab, which is the fintech app. That fintech app, Grab, now is supporting stablecoin payments. So you're starting to see this world of which, okay, well, stablecoins have real product market fit in those places. They have 160 billion outstanding. They're doing over 50 billion in monthly transactions. And it's growing extremely quickly. And this is obviously going to continue to grow into the future. Today, that market is really dominated by Circle and Tether, with Tether having 77% market share and Circle having 20-25%. But there's issues and potential ways of which they operate, which are not optimal. And so we see that market, which I expect to grow tenfold from here in the near term and much bigger than that in the long term. We see opportunities for startups like Agora to really make a dent and take a lot of market share.
Maybe just framing it for the audience, generally the critique around Tether is opacity. There have been questions around their compliance with international law, facilitation of money laundering, concerns around those areas, validated or not. And then with Circle, it's that it's a very centralized counterparty, or that the Circle business model is basically offering zero yield bearing stablecoins and then basically capturing the yield generation of the underlying collateral portfolio? Or are there other critiques that you see?
So Tether and Circle both have the same problem that you just talked about, which is the economics, which are essentially saying, okay, you give me $1, I will issue you a digital dollar, and then I will go and put that into a treasury and I will take that entire 5%. Fantastic business model. Tether is the most profitable business that has probably ever existed.
It's like 80 people and they make like $4 billion a quarter in profit.
Tether, to your point, they own the global market. So Circle is barely used outside of the US, or outside of really large institutions. They have a lot of trust in those emerging markets, and they have a lot of trust among the trading community in crypto. It's for a couple of reasons. To your point, people have been concerned about the backing of Tether for a while. And I think there, is a possibility when you look back at how opaque they were at times about what their backing was, there's a possibility that they weren't always fully one-to-one backed. They do an attestation today that is not the same or the level of an audit, but that attestation shows that they are fully backed and then some, and they have quite a bit of reserves. And I think the market got a lot more comfortable with them following two things. One, where last year around this time, Circle, who is utilizing and was utilizing at the time a lot of US banks, had essentially a depeg, or the USDC token was no longer pegged to the dollar. And that was because they were dependent on the US banks who were having a banking crisis last March. And people were concerned that Silicon Valley Bank, one of theirs, would go under over a weekend and that they wouldn't be able to get their cash out. And so what became clear is that dependency for Circle on the US banking system, that kind of shook people. They thought they didn't really diversify in a way that made it as riskless as Circle would like to tell people. At the same time, Tether didn't have that issue. And in part because mostly they bank internationally. But they also have a better brand. They've just been able to go to market better. They're run by a non-American. And so they basically owned all of the emerging markets and all of these, more of these use cases that we talked about that are real world use cases, which are things like B2B payments. Now, Tether has taken a little bit of a turn for the more legitimate this past quarter or two, because they've done a couple of things. One is they've been very responsive to US regulators and the FBI and DOJ when they've asked them to freeze wallets who are known to be linked to places like North Korea. And two, Howard Lutnick, who runs one of the biggest asset managers and banks in the world in Cantor Fitzgerald, he came out and said, I actually have seen all of Tether's reserves because I am the one that banks them. And he's obviously got a lot of reasons for wanting to show that Tether is legitimate because he's taking pips on all of that. But he also wouldn't have risked the rest of the business to come out publicly and say that if he didn't truly believe that they were a good actor. And so that's put a lot of wind behind Tether sales. I think Circle has always had that legitimacy with people, but they're kind of stuck between a rock and a hard place, which is that they want to have this legitimacy in the US with regulators, but the regulators are also still thinking about, what do they need a banking license or not? And they're competing against things like JP Morgan coin and these bank issued coins, which may come for some of these settlement mechanisms. And they're not able to sell in the more retail oriented use cases. And so they're stuck between this rock and the hard place. And so that's where Agora comes in, which is super interesting, which is that they are able to beat both of those guys in terms of essentially just undercutting them on price, because they're saying, okay, well, we'll take your dollar and we'll issue you a new US digital dollar in Agora. We will go and put it in treasuries, which are, by the way, that treasury program is being run by Van Eck, one of the most credible asset managers in the space. And it's being custodied at, I think I cannot say who, but one of the largest global custodians in the world. And so they're bringing that institutional credibility. But then they're saying, okay, well, we'll work only with businesses, so we're regulatory compliant, so exchanges, custodians, wallets internationally. But then we'll just do a rev share. And that is essentially undercutting the other two on price. But they're doing that with Circle's institutional credibility that nice Tether maybe necessarily doesn't have right now, but also with an ability to go to market globally with all of these different businesses that Tether has that Circle doesn't have. And so they're really attacking both from different sides. And that's where I see a big possibility and potential for them to grow into.
That makes a lot of sense. And because they're working with businesses, institutions only, they're able to operate in both the US and abroad, or it's a non-US focus?
So non-US today, it's only international. There is hope that it'll be US pretty soon.
To that point, looping back to one of the bills you mentioned earlier on, the stablecoin bill. I'm not familiar with the details, but it did seem, based on a high-level reading, like it, perhaps not surprisingly, is prescriptive in terms of who can issue stablecoins in the US. Presumably that power would ultimately sit with regulated institutions like banks and similar. Do you have any more context on that regulation and what it might mean for stablecoin issuers in the US?
So the big stablecoin bill that was hotly debated in 2022, that's kind of died off. We might see that come back, but I expect it to take a different form. That said, one of the things that was put in there was that you might have to have a bank charter to go and issue a stablecoin, which would essentially kill these technology and payments companies who want to do their own stablecoin. So Circle, they don't have a bank charter, and so it would make it really tough for them on day one, because they do operate here. But also Paxos, which is another competitor, and then Agora and others. And I think it would really enable like JP Morgan to cement themselves, and frankly, like would probably kill some innovation around that, because JP Morgan has no incentive to open up the financial system. So that is one of the big concerns I had about that bill. I'm hopeful that we get something different, and I expect we will either later this year or into next year, and we'll see what form that takes. The other bill I mentioned earlier was a bill that passed today, and that bill doesn't allow the Fed to issue its own CBDC, because the concern is that you'll use CBDCs to essentially spy on and not give financial privacy to Americans, and I tend to agree with that.
Got it. Okay, makes sense. Maybe then zooming out a little bit, but staying on the stablecoin subject. So given all of this, right, I imagine you're playing a little bit of forward-looking chess in your mind or with your investment team as you're backing a company like Agora. Sounds like an immediate opportunity, i.e. next 12 months, they could be really successful. But what do you think the stablecoin market could look like in, say, 5 years, given the Washington regulatory piece, the bank regulatory piece, and also the innovation onshore, offshore, existing players, potentially new approaches?
I think stablecoins are just going to continue to grow massively and proliferate. I expect that by 2030, we're at a minimum over $1 trillion outstanding. And so that's 8x from here, a little less than that. I wouldn't be surprised if it was a lot more than that. My guess is that when we reach kind of critical mass, the federal governments of these different localities, they'll start to believe that they have to integrate stablecoins into the financial system themselves. And that'll just put tailwinds behind the entire market. And that could propel us to being as big or bigger than the euro dollar market, which is 15 trillion, like I mentioned before. My expectation is for you and I, the consumer, is it actually doesn't feel that different from the way you interact with the world today. So most of finance today is bits and bytes on a screen. You go and you log into your app or your phone and you move some money around. But what is happening is you're waiting for a couple of days because of the correspondent banking system. If you're sending overseas, you're potentially having issues where the bank themselves are losing wires, or they're having to triple check and confirm with you. There's no transparency. So you're checking back to make sure these things are finalized. And what I think will be true is that when stablecoins start to proliferate in that way, those will be integrated into things like fintechs, payment providers here and globally, in the way that maybe you see PayPal trying to do right now with PYUSD and putting that in their Zoom product, which is their cross-border payments product. And what that means is there'll be lower fees, there'll be instant finality, there'll be better transparency, but it will look basically the same otherwise. And it'll cut out those intermediaries. And so it'll be just a market that is better than today, but won't even require that much change in how you think about your experience with financial products. It'll just be better for you. But the really interesting thing about this is in the US, there's been a lot of this concern about stablecoins and how you think about what that means for the US dollar. And I've always been a proponent that this is actually great for the US. We're at a time today where the biggest buyer of US treasuries and agency bonds was China until recently. Now it's been Japan recently. And they have now started to offload treasuries and agency bonds at a faster clip than ever before. In fact, China offloaded over 53 billion of treasuries and agency bonds in the first quarter. And it's clear that they feel, especially post the Russian sanctions, that maybe the US credit isn't actually that good, or US may decide just not to pay them and pay the interest on those bonds the same way they decided not to do it in Russia because of the OFAC sanctions. And China said, hey, listen, we need to be actually not so dependent on the US. And also, we might be in this world where they're in a bit of a currency cold war, and we want to protect ourselves. And so we're now at this time where US dollar proliferation has slowed or is even reversing in a way that has not happened in a really long time. And so if we want to continue to be the dominant world currency, which is good for national security, it's good for business broadly here in the US, stablecoins are a way to do that in a new market that we haven't really had an opportunity before. And I think is absolutely fantastic for the US, and regulators should start, and Congress should start to understand that.
Stablecoins is not the only part of the crypto world that you look at.
Right.
Interesting as it is. What else are you excited about right now?
I might give you a less sexy answer than some of your other guests, but I'm continuing to be really focused on DeFi. To what we talked about before, crypto has its roots in money. It has its roots in finance. And right now, financial services don't work for a lot of people in the world. There is I think, a blind spot to that here in the US, because in many ways, financial services work pretty easy for Americans, but it doesn't for people elsewhere. And so bringing DeFi and on-chain finance, the immutability, the transparency, the access to different types of products that doesn't exist otherwise and very cheaply, that I believe is going to continue to take off in a way that we've seen it kind of proliferate over the last number of years. Now, a lot of that has been, people talk about the casino, and a lot of that has been around people wanting to gamble on different types of tokens or trade different types of tokens. But the core use case of DeFi, I think over the long run, is not just going to be the casino, but it's going to be providing open finance to a lot of people. Also, really interested in digital identity is going to be really, really important. And it's going to be really important with verifiable understanding of whose identity that is and where it comes from, and being able to not have that identity tampered with, especially in a world of AI agents proliferating and where proof of humanity is harder to determine as we continue to have these LLMs get smarter. An offshoot to that is zero knowledge proofs. And zero knowledge proofs allow us to scale crypto, but do so in a way that still preserves digital privacy and has a lot of use cases around identity as well. It doesn't have to be in zero knowledge, but those things kind of can go hand in hand. But zero knowledge also allows us to do some of these financial applications on chain in privacy preserving ways that hasn't yet proliferated. And so I think zero knowledge broadly is going to be a huge tailwind to application building in the space.
Question for you. You see so many different companies. This is actually, I guess, a question that in a handful of ways I've raised with a few different people now, just because I'm still trying to wrap my head around it. You talked about DeFi, for instance, being one of the areas that you're most focused on. There are different approaches, it seems to me, to building DeFi. One is a sort of fully decentralized, DAO-led from the beginning, open source infrastructure type play. Another is an equity business that is building maybe a protocol and monetizing it in a certain way. Sometimes value is accelerated through a token launch. Sometimes you could look at a DeFi project through more of a fundamental valuation lens, maybe transaction fees that are being generated and DCF that over time in a growing market sort of thing. How as an investor do you think about, or maybe the better way to ask the question, what's the optimal structure? If a founder wants to build in DeFi, what's the best way for them to structure their business to make it both investable, to give them best control over execution, but then also to make sure that they can get maximum reach and adoption?
I don't think it's a one size fits all. So I don't think there is necessarily optimal. What is true is that you have, like you said, different types of go-to-market or different types of ethos around building. And in some cases, it makes complete sense for there to be a centralized equity business that is operating maybe a tech stack for accessing DeFi. You might be interacting with institutions where there is strict KYB standards. The institutions themselves are quite focused on making sure that they are OFAC compliant, that they understand who's on the other side, that there is clarity into what their positioning looks like. Those types of businesses, they're meant to have equity because they need to have some centralized control to operate in that market. More broadly, DeFi, as people think about it, is meant to be decentralized, right? Like that is, in the name. Right? Decentralized finance. And so for most of what people actually think of as DeFi, decentralizing over time is important. Now, what we have seen is often there's this period of time where if you want to ship quickly, if you want to build an innovative product quickly, you probably need, or you may need to be centralized for some period of time. But what we really focus on is that you have that clarity of vision if you're a founder. So if you're a founder who says, I want to build in DeFi or CeFi, you say, okay, this is how I'm going to accrue value. And I'm going to accrue value to a token and I'm going to decentralize. Or I'm going to be centralized and I'm going to accrue value to equity. But if you have clarity and it's the type of value accrual mechanism that we think makes most sense for your business, that's fine. We will do both. And we consider ourselves best-in-class investors in both sides of that market. But what I also want those founders to do is I want them to have a lot of bias towards shipping quickly. So you ship quickly and then you decentralize, or you ship quickly and then you don't. But don't get caught between a rock and a hard place. And I think that's what some founders have really struggled with. And that's in part because of how unclear the regulatory regime has been, here in the US. And I think if we get clarity, that'll actually change some of that. So all that to say is there's not necessarily one right answer, but you have to have a very clear vision on how it makes sense for your business and which path you want to go down.
What's your AUM at Dragonfly? How big is the fund?
Our regulatory AUM right now is around $2.5 billion.
How much of that is deployed versus dry powder?
So just for a little bit of context, we're currently investing in our third venture fund, and we have 2 venture funds that are fully deployed already, and then a long-only, low-turnover liquid fund called Metastable that existed for a long time that we took over. So that fund is almost always in the market, and then the 2 venture funds were fully deployed. Our current fund was $650 million of committed capital, and that fund is 85% deployed or so. So we're pretty fully deployed right now with $80 million or a bit more in dry powder.
Numbers like that make you among the larger crypto funds, right? Crypto-focused funds.
Yeah, I think it's probably Andreessen Han, Paradigm, Pantera. There might be 1 or 2 others. I think in terms of this current fund size versus our peers, we're kind of right there, but we're somewhere between top 5 and top 10 in terms of size.
That has some practical impacts, right? Which means you need to invest in potentially big outcomes to move the needle. And if you were investing in broader tech, maybe it wouldn't be that difficult to generate returns on $650 million. But investing in crypto, maybe it is, because at the end of the day, it's still quite a small market. What implications do you think it has to the way that you and your partners think about the sorts of companies that you're investing in, whether it's the stage, whether it's certain other indicators based on the fund size?
Yeah, you have to take it into account. I think a lot of people in crypto have done a bad job about understanding that portfolio construction matters and sizing really matters. And so I have a background in more traditional institutions pre-doing crypto. And we always talked about positions, especially at this hedge fund I used to work at, in terms of percentage of the fund. Because that's how you figured out, how much conviction you had, but it had to be a big enough percentage to still matter to the fund returns if you had some good return out of that. And so what was true of crypto more broadly in 21 is that people were just, party rounds, everybody was taking a little bit of allocation, and then something might, 100x, but if you 100x $1 million in a $650 million fund, well, that's great. It doesn't actually matter that much in terms of the broader fund. And so the way it's changed for us is we've had to be really thoughtful around how much do we own? What are our minimum ownership percentages? We have to lead. We can't really follow on in most types of deals these days, except for the very, very late ones. And we have to be judicious in supporting our portfolio so that they understand how to think about sizing from the different investors. Because a lot of times we'll do a deal and they'll say, hey, we want to bring in like all these people. One of the things that we said is, I think is broadly true, is if you bring in 15 different venture funds, it doesn't matter enough to any of them. And so you don't get the support you want. And so if you really want support, you kind of need to let somebody like us or one of our competitors take that big chunk and have that minimum ownership so that they really care about you and you really matter to the fund. And then they can put their full force of their firm into supporting you. We have to make that clear with people in a way that we didn't have to before. But it's a conversation with every investment we do in a way that honestly it always was in Web2 VC funds. It just kind of got ignored for part of time here in crypto.
Is there such a thing as growth stage crypto?
It's a good question. I think people debate this a lot. There's one fund called 10T, which had existed to only do crypto, or they call it digital asset ecosystems, how they like to refer to it, in equity-only businesses. That part of the market's been really tough. And we saw in 21, a lot of the big TradFi investment firms, KKR, General Atlantic, Tiger, Coatue, all these guys came in and they started investing in those types of businesses. But we haven't really had, frankly, like the public markets haven't been open for tech more broadly in a couple of years, let alone crypto. And that part of the market's been pretty challenged. I think you have to be really thoughtful in that space. And it does exist. There are equity-only businesses in crypto that need capital or growth capital at the Series B plus stage. Just being a generalist investor to come in and write checks into these things, that has proven to not work because those investors don't or haven't thought more fulsomely about how the market is evolving. So we do those growth checks, but it's just not a big market today. And there's really only a couple of us that do them in the space. On the token side, there is, so Farcaster just announced their deal with Paradigm.
It's like 150 million or something that is what they raised?
Yeah, $150 million. Yeah, exactly. At a $1 billion valuation. And that's a application layer product that has real users today. And that was kind of one of the first deals where you could see, okay, well, there's like token value accrual here, and it's getting done in kind of a growth equity style. And that is coming back. Previously, we had only seen those types of big token rounds happen in like pre-launch L1s and L2s, which aren't growth as we think about them because they're essentially still pre-launch tech products. But we're starting to see it come back, and I'm excited for that.
The cynical view on like the L1s and L2s is that people have capital to deploy. It's hard to deploy a lot of capital into many crypto projects. It seems to be easier to deploy a lot of capital into new L1s or L2s. And therefore, they serve a purpose almost. But no one really seems to be able to answer the question with that much clarity. Why is this going to win over Bitcoin or Ethereum or Solana or whatever it is? But zooming out from that point, given the small number of growth size rounds, so to speak, does that make them really competitive?
You would think, but we haven't actually found that to be true. I've actually found seed stage to be more competitive. And the reason I say that is this: none of the funds in crypto, or almost none of them, are actually still big enough to write a $150 million or $100 million check. And so there's still an ability we've co-led a deal with Paradigm last year. And so there's still an ability to do co-leads like that. And there's only a few people who can really write those checks. And so there's a possibility in a really, really hot deal. And I think on the L1, L2 space, that does happen. At the application layer, we haven't yet seen it be that competitive, or even the equity businesses. The seed deals are actually much more competitive because there's probably, call it 300 firms that are looking at these things. And people have learned the wrong lessons from crypto, which is that if you do a token deal early enough, you get liquidity. And so it's de-risked really quickly and you probably can't lose money. And so they're willing to pay crazy valuations for things because that's what they saw work in if you were early in 2017, 2018, 2019, 2020. So we still see those seed deals get actually like incredibly priced up because people are like, I'm going to make money no matter what. And so that's where it actually gets really competitive. That said, there are probably only, this is kind of a different point you made earlier, but there are probably only $300-400 million of really good deals a year, maybe a little bit more when we get these like $150 million Farcaster deals. But there's not a lot of really good deals yet in crypto because it is still a small market. And so the amount of just capital raised by asset managers and venture funds that they had to put into the market has meant that people are piling in evaluations that have just not made a ton of sense. And so being judicious there is something that is still really important for us, and it's important for others.
Well, look, this takes it full circle, right? Because if we can get the sort of regulatory clarity that we're looking for and the changing winds in Washington to actually unlock the sort of innovation at scale that I think we're all craving, this problem would take care of itself. Suddenly from 300 to 400 million of deal flow a year, it's 10x that fast. And that would be very exciting.
Absolutely. I cannot wait. There's nothing I like more than putting money into a hungry entrepreneur who's going to build something cool and then watching them go through that life cycle. So the more innovation we're going to have, the more exciting it's going to be for me.
Amazing. Rob, well, thanks for connecting. This was a really great conversation. Really appreciate your views.
Really appreciate the time. It was a lot of fun, and thanks for having me.
Rob Hadick, thank you very much for joining us today.
Thank you.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.